All right, cool. Sweet. Hey, Nick.
Hey, what's up?
So, well, I don't know where you want to start.
Do we have people?
Yeah,
Let me
yep,
see.
we have some
Where's
people
the
in
list?
there.
Where's the list here?
Um,
Oh, here it
25,
is.
I think.
Participants. There we go. Okay, cool.
Yeah. So I don't know where you want to start with this. I had a couple of ideas whether we could go over a couple of trades I was thinking of at the moment, and then see how similar trades would have fared in the past. Or you want to just go from the top down and explain, ask QS, kind of how it came around, and then using it. Or
I think what we can do is sort of give a little bit of I'll do a quick overview for people, and then if you want to take it from, if you want to, let's show people what's out there, and then do like some quick examples, and then if you want to jump in and do some examples that you've done, and then we can just you and I can go back and forth about how to potentially look at that stuff historically and that kind of thing. So
all right, so that
uh,
sounds good.
that,
It should let you share your screen. Um,
yeah, let me
You
shut
can either
down.
share a whole window or you can share just a portion as well.
Yeah, let me get over here. I'm gonna see what I can do. Share. I want to share. There we go. Can everybody see that?
No, not yet.
Oh, here we go. Sorry.
Yes. Yeah, I can
Got
see
it.
that now. Yeah.
All right. So, okay. Let's see. I want to see who's there. Get that up there. All right. So, this is Nick. I've communicated with a lot of you guys either via email or some other way, or the chat with the Macrohedged chat. So, what I'll do quickly is, Hugh, how much time are we talking about today, or is it just,
Or whatever you need, really.
Yeah.
Yeah.
All right. So for a lot of you, you may not see this little piece up here as part of the trial. Once we get done with this, we can talk about what we can do to make that available. But really, what I want to make sure that you understand is just sort of how to approach this. The backtesting is going to be part of the Ask QS section here. And can you guys hold on 1 second? I am sorry. Give me 1 second. Hello? Hello? Okay.
So the guys on the trial, make sure that you're, logging in. Nick has his own YouTube channel, and also with the course, obviously he's done a fair few hours of videos as well. So if you're on there, you're on the trial, make sure you're checking it out. No point coming back like 5 days before the trial ends or day before, and then saying, "Oh, I wish I had looked at this, looked at that." He really does go through everything, and the problem with QuikStrike is there is a lot to learn. So I mean, you're going to be you're going to need the month to get into it. If you look for QuikStrike on YouTube, you should find it. Let me see if I can find a link to it. Hold on. Right, here you go. Here is a link to his YouTube channel.
Okay. Sorry, guys. Had to take that one.
Oh, no worries, Nick. I was just saying you've got your own YouTube channel, and obviously you share a lot of tutorial videos on there, and you've got all the videos that you did for the course as well on using QuikStrike. And if you're using the trial, get using it. Don't come back at 5 days before, 2 days before, and say, "Oh, I wish I'd looked at this or done that." So.
Yeah, I'm glad you mentioned that. I mean, I'm generally pretty gracious about things, but it's really to this point, we put out enough notifications to say, hey, it's time. And the reality is that most of the trials that we give, or people actually pay $25 for a 2-week trial, because we over the course of the 10 years or so that we've been doing it where we actually had individual users come in there, people just sort of abused it by just registering over and over again with different emails. So we finally charged them. So use the time, because it'll be December 31st is the cutoff for everybody, regardless of when you start. So that's and most of you either cut off or registered via subscription, which I appreciate, and the rest you probably have time left before your subscription ends. Anyway, so let's get this started. And I apologize for the interruption. It was a work call, so I had to take care of that. So AskQS, you're gonna see QuikScript, QuickDNA, and the alerts. These 3 things are functional right now. These new ones, these 2 other ones are in beta. We're not releasing them quite yet, just because they're not quite. This one's not quite user friendly enough, and this one I'm not sure what exactly how I'm going to present that. But you know, these really work in conjunction here in a lot of ways, because this lets you look at data historically and sort of see locations where you might want to put on a trade. Then you can set yourself some alerts based on this information, as well as any spreads that you build to let you know, hey, this is at a tradable location from a price standpoint, from a volatility standpoint, that type of thing. So we're just going to start really quickly with this QuikScript tool. Don't really be put off by the fact that you're like, oh, how am I going to remember all the nomenclature and that kind of thing. It's actually pretty straightforward once you get used to it. And what I think you'll find a majority of the time, at least Hugh and Adam and I, when we're playing with it, we really think generically to find things, and then go back and look at the individual strikes that are associated with a particular spread that you want to put on. In any case, let's just talk about what this structure looks like here. And you're seeing a similar thing. You're going to be you'll see the trial settings up here, how much time you have remaining. And then when you come here, you'll see a recent tab, a spreads tab, generic, backtest, and sample. So the recent is just going to keep track of any information that you type in there first time, you know, when you're looking for a spread. Okay, so if I go and I'm going to make sure I can see what I want to see here. So that's the front contract. So we'll go to March. So for instance, if I want to look at, I'll jump around. So if I want to look at a March, so right now, March futures are trading, 58.5 roughly. So I can come in here and say 58.5 at the bar or straddle, okay? Okay, now I'm typed in straddle completely, but I can do a bunch of different shortcuts. I can type this caret, I can type straddle, and I think I even have STR in there. But you can see I'll click over here once we push enter to show this initial sample. I'll show you where you can find all of the help for the AskQS QuikScript section. Okay, so if I type this in, and it's going to come back, and you'll see it put the string into my recent spreads tab. You'll notice that this add spread showed up, and you'll see over here that it showed the prices currently for this March straddle, 58.5 strike. Okay, I specifically asked for that one. Okay, so typically how I use this, or how I like to use it, I'll just put at the money like that, and you'll see I'm going to get the same here. It gave me 58 because the futures are actually at 58.12 here. Okay, and this, so it's going to go find the strike that matches most closely. Okay, and you'll notice here that it found a strike and then put it in here, so you can actually see what, and you can copy it and click it and save copies to the clipboard if you want to send it to somebody. But you notice it also showed up in your list as an ATM straddle. Okay, that's the first and foremost thing. If you want, so what you can do, if you want to say, okay, I'm going to save this 58 strike and I want to follow this 58 strike, what I can do is I could say add this as a spread. We consider this the spread where it actually has the strike in there, and we consider this the generic where we kind of talk to this and say, hey, go find these strikes based on this criterion or criteria that I have in my quick script string. So if I click on add spread, it will put me over here into this spreads tab, and there is my 58 strike straddle. So it took the actual strike that it found and put it in there, because now it's saying I want to track this particular thing because maybe I traded it. And you'll notice here, add generic is still there. If I click over the generics, there's nothing in that list. But if I say add generic, now what I typed in here as the generic is in this list. So how do I think about this? And again, this all relates to the back testing for a few reasons, because as you find you're doing your trade investigation, you might pick generics that you want to watch over time, or that you're looking at something that's happening right now and you want to go back a month or a couple months and see how things fared, right? So we'll get to those examples as well. So now you'll see here, here's my generic, here's my spreads. I'm going to nuke this one since that's not part of our example, and here's our recent. Okay, so that's sort of the kind of the simple, fast initial example. And I can come over here and just say straddle, so I don't have to type anything in. And again, you see the same thing. It did the 58 strike straddle. Now you're going to go, gosh, how am I going to remember all that stuff? If I go over here to samples, no matter what product you happen to be on within QuikStrike, you'll see examples associated with starting with the front contract and then, you know, moving out. So if there's calendar spreads, they'll do the front second, that kind of thing. If you're looking at you know, front contract, second contract, most open interest contract, it'll go find those specifically for the product you're on. So as a for instance, let me show you what that means. If I do TYH0 after money straddle, okay, took me over here back to my recent tab. But if I come over here to the samples, now these are all going to be TY samples, okay, and they're all the same. Nothing's going to be different for each product. For every product's they're not going to have any uniqueness to it. But this way, at least lets you start to experiment in a product that's your favorite product, as opposed to something that you're not comfortable using on a regular basis. And jump in with hands or anything like that, or questions, just let Hugh know and he'll shoot it over to me. But as you scroll down here, you're going to see there's all kinds of examples here, and you'll see there's sections for all the generics are below each kind of the specific examples that have actual strikes. And again, you'll see these strikes are going to also be present strikes, meaning that we didn't just fill these in with, we're basically doing generics on the back end and then presenting them here so you can see them. So there's always an example that's valid in this list.
And if people want to know more about each of those spreads, in the Quick Edu tab, they can learn about the spreads, right? So then
right. So there you go.
Trade examples, yeah. So now you can go through and you can see the see which spread. If you've got a query about the spread, you can't picture it in your head, then you can go here and see that as well, in case that list is a little bit daunting. Straight up.
Yeah, that's exactly the case. And to be honest, for people that are listening, I don't know the experience level of everybody here, but start off with the intra-month straightforward spreads, learn from there, and then start worrying about going out into the calendars and that kind of thing, because you're just going to run into trouble if you try to do.
Yeah, option calendar spreads are different. They're different to futures calendar spreads, right? There is a lot more risks that you need to start worrying about. It's a lot more things to worry about anyway. So yeah, just learn the dealing with 1 month first.
Right. That's how I would start it out for sure. Okay. So, and then to go further from that, here is a cheat sheet. So this is I don't think this is gonna show, because maybe it'll show. Is this showing? Do you see the PDF pop up? Did it show?
No.
Yeah, it did not. Yeah, it's because how I'm sharing. But you'll see that there's a PDF that pops up that's basically that you can print out, and then also this is the longer guide in general. So this is a couple sheets, and this is you can print this out and do double-sided, and you'll have one sheet that has everything that you need, and then this one is going to just be the one sheet in the front, and then the full 10-page explanation of what's going on with each thing. Okay, so just a few more examples here so we can see what we got. So I can do an LOH0, and again I can do a 58/59 call spread. Okay, it becomes pretty straightforward there. 58, 59 call spread. I can do a call. So now watch, I'm gonna have an error here. I'm gonna say call fly. All right, this requires 3 strikes, okay? So I'm gonna 58, 59, 60 call fly. All right, so that'll come here. Oh, forgot the slash. There's the call fly, okay? And again, same thing, if I do a condor, it's gonna give me an error. And I can say /61. Okay, so you're going to use, and again, you'll see through example and through trial and error. You don't feel bad about, you know, making errors. That's the whole point, is to play around and see with what works. The big tricks you're going to have is, you know, there's a space between the C and the call or the put, or I can do put here too, and it'll flip it around there for me, although it's not necessarily the direction I would go with the put one. But there's a space between what type it is and then, you know, the resulting spread that you're trying to find there. Now, you saw we did a 1 strike wide spread here, right? So what's interesting is I can do, instead of that, I can say 58 plus 1. Okay, and that will do the same thing. It'll start at 58 and it'll go, won't do this. We have half strikes in here in Crude. So what this did, it started at the 58 and did 1 strike increments, and it built the condor. If I wanted to get that full $1 point, I could say +2, okay, and it'll take care of it for you there. So there's a lot of neat ways that you can go about sort of building these things. And you can go a step further, and I could say, instead of 58, and I want to track this all the time, I could say ATM +2, and I want to do dollar wides. So now this is my generic, and I can just click on that, and now I have a generic call condor set at the money and $1 wide all the way up. So there is lots of power in here. Okay, so so play around with it and get comfortable, and don't, you know, and you can't hurt anything. So type stuff in. It's in your recent. Okay, and it will be it will come to you very naturally before you know it. Okay, so a couple other things you can do here now. So like I said, I tend to not even think of the straight up strikes, because if you're looking at, you know, the futures move, you're not exactly sure where it is. You kind of already just know where the futures are, but ATM just seems a lot easier, or you know, using a delta.
From an option standpoint, yeah, it makes way more, yeah, so much more sense to do that.
Yeah, right. So another thing you could do too is, like, I can, you know, the generics, like I said, we're using an agnostic term that goes into the actual expiration and finds where that term is in the strike list. Okay, so now say I want to look at the 25 at the money 25 delta call spread. Okay, and you'll notice that it's going to go, and here's my delta at the money, and here's my closest to 25 delta here. Okay, so it's going to go find the strike that's closest to the 25 delta and create that call spread for me. Here's my generic, here's my actual spread. Again, I can save the actual strike spread, or I can save the generic. Again, if you come up with a pattern of trading that you're always looking at these things to see where they are, that type of stuff, this is the way that you want to go. Okay, so now next step too, I can say 15 delta. I can add that to it. I can put fly here, and now it's going to go out there and find those 3 strikes. So as you start to do your back testing, you know, especially when you're going to go to a period of time, you know, you go past a week, you're not going to necessarily know what the strikes were on that given day, right? So if you're looking for a strategy, or if you're building a strategy based on something that you decided works for you, then this generic way of thinking about it and asking for it really
it makes a huge difference. Otherwise, you think, say you go, oh, okay, I'm looking at a spread 2 years ago, then you got to go, okay, what was the front month? And then, you know, then you got to go find them. Yeah, especially in something like Bloomberg, you got to then find the code, find them, you know, and get it all in. And you'd be like 10 minutes before you found what the spread is. So this is going to save so much time with this.
Right, and you know, let's even go back. Let's go back to the 29th of November, right? Think about that. At the money, we're up since then, right? The futures are up since then. So let's see what we got back then. We got an error here. Here we go. Yeah, so on on the 29th, I think they were around 55.5 or something. That's what I'm looking at, or roughly. So if I want to go say, hey, what did this thing look like on the 29th of November? All I have to do is add a DT colon, and then do, and again, for people that are in the UK, you're gonna, or Europe, or in the European Union area, right? Or anywhere where they put their day first and the month second, you just type it in as your local date format, okay? Whatever your browser has, that's how you do it. So like for Hugh, he types in 29/11/2019, okay? Or just, or 19. And I have to type in, since I'm in Chicago, okay, like this, all right? So now when I do that, so what happens? It went back to the 29th, and it found, you're gonna see, look, it found that at the money was the 55 strike, okay? So this is the current valuation of this spread, okay? This is, you'll notice it says the 29th, okay? On the 29th, it was worth 1.5, and you're gonna see your P&Ls over here for where you basically, what's happening is QuikStrike is going in there, marking the trade date as the 29th, and then setting its, showing its profit and loss table from the spread builder over here. Okay, so so this is, and you'll see these are all generally going to be the same, these sections to this last three of the premium leg and of the P&L. So what we just did is we just back tested, okay, and technically when we're looking at this, I'm going to show you it's a back test, but it's really just looking at an active expiration and what it's doing now. A back test is truly defined in the AskQS is when you go back far enough that when you come to the present day, that expiration no longer exists. Okay, so that's the true back test, and you'll see things a little bit differently once we do one of those. Okay, so now, so we chose the March contract, but let's go back even further. Let's say, let's do the October 29th, okay? And I just did that, and now look, at not much different. I'm still on the 55 strike a month, even a month further, okay? Back, a month farther back. So, but, say at this point, the days to expiration now is 70, and the days to expiration back then was 107. Say I wanted a couple things. I wasn't really concerned about March back then. I want to look at what the front contract was doing at that point. Okay, so now what you can do then is I can say, instead of H0, I can put 1 exclamation point. So these last two sections are going to say, give me the front contract on that day. So when I hit enter here, it's going to go back, and the front contract at that time was the D's contract. And since that was a ways away back, that front contract only had 17 days to expiration. So now you're going to see it only shows what that was on that day. Since it doesn't exist anymore, it's only showing what it was on that day. And you'll notice here that now it says add back test. So this is truly a back test because we went back in time to an expiration that no longer exists. Okay, so so now if I click this button, add back test, it will put this into my back test folder. Okay, so you say, okay, great, I got the front contract. I really didn't want the 17 days to expiration, or I think I'm really mostly trying to pay attention to stuff that's, probably at least 30 days to expiration, maybe more. So another thing that you can do is you can make the next adjustment you can make, say, give me the second contract, okay? And what that'll do is going to go and find out, and that was the Jan contract at that time. So I want the second contract, and now you'll see Jan contract still around at this point, okay? And it has 10 days to expiration, but back then it had 47 days to expiration, okay? So it's just another way of sort of pinpointing. So you have a generic not only for the strikes within something, but you also have a generic for the expirations that you're looking for on a particular day. And I just think that this is way more useful than trying to go and find, to go back and look up and see what you're trying to find. Now, the other option we have here is you say, well, I really want the contract that's most liquid at this time. So if you do LO0 exclamation point, okay, what that's going to do is going to go back and find the expiration on that day that has the greatest OI, okay? So if I hit enter here, odds are it's going to be the same thing. And it was Dece, all right, it was the front month was the greatest one, okay? So now you see there's multiple ways that you can go find a particular expiration generically and then find the strikes generically. So this saves you lots and lots of time instead of having to go back and look at something. So you're really getting a nice peek into some historical data without having to really do a lot of investigation on your own. Okay, so let's go one step further now here. So I said we did front contract, second contract, most OI contract. When I did the second contract, on that particular day, Jan had 47 days to expiration, okay, from what we saw. But let's say, 47 is not, I really want to look at something that's closer to 60 days to expiration. So what you can do, or greater than 60 days to expiration. So what you can do is the following. I can do a greater than 60, okay? And if I hit enter, it's going to go back on that day and find the expiration that had 60 or greater days. So now it went out and found the Feb contract, 77 days to expiration. Okay, and now you see this is where things were on that particular day, and here's where they are right now. Okay, so some real cool stuff you can do. Any questions there, or Hugh, you want to add anything?
No questions. There's a couple of bits, but I don't know if you'll get to them in a minute, so I don't want to.
Okay. No problem. So that's what we have that greater than. It says go find me something that's greater than 60. As you would expect, I can say find me something that's less than 60. It'll find the first one that's less than 60. And the other thing you can do is you can say find me something that's, if I do a hash on there, it's going to say find me something that's close to, I want the 90 or whatever's closest to 90. And here it went out and found that, the Feb contract again. And let's go out a little further. Let's say 100. Okay, it's probably going to go a step out. Okay, so a lot of ways to go out there and take a look at it and find stuff that you're looking to try to do. So now I'm going to get rid of this, and I'm going to do, let me seed it with this. Okay, so when I click on one of these, what's going to happen, it's going to roll the most recent click up to the top of the recent tab. And we do that is because we think that if you're clicking that, that means you're interested in it again. So now you want it to float to the top. So you're going to have 20 in here at any given time. And whatever, if you go back and click on one, it's going to roll back up to the top. Okay, so now let's go take a look and say, you know what, I want to do the 60-day expiration. I want to look at the call spread. I want to go back to, let's go to 11/01, and I'm typing out the full date there for the. You don't need 01 there. I'd put out there so it's easier to see. So I'm going to go back and look at the call spread on this day. But now what I'm going to do is I'm going to say, hey, I want to hedge this thing, F, so I can hedge this. Or I'm sorry, I want to price this on that day with the settle price. Okay, so I can price it with the settle price, or I can go a step further and I could say I want to hedge this with the settle price. If I say go, H is their hedge. If I say whoops, I don't have, what did I do wrong? Let me do this F first. There we go. Sorry. STL, did I screw that up? All right, yeah, so what I went back was, I went back on this day and I priced it up with the settle price for the future on that day, okay? Why didn't my hedge work? What I can also do is
it not always applying the settle price?
It is always applying the settle price, but I could also do, it's going to apply the settle price on the back date. So what I could do is I could also say I want to do 56.0 like that.
Right. Okay. Yeah.
And then I priced me up on my 56. But
yeah.
I wanted to. Maybe I didn't put hedge in. Maybe hedge isn't released yet. So let's do this. Maybe I'll have to check that. I'll check with Tony. Maybe I didn't release hedge yet, so I apologize for that. So what you can also do is you can say, okay, go back to the 11th, and I wanna say that you did this spread because, like Hugh likes to do, you think you're buying that to money and you're selling the 25 delta because you think it's expensive. So, and in this case, we see here it is a little bit more expensive. What do we got here? We sold the call spread. We sold the call spread. Yeah, so I'm going to do it the other way.
Yeah, so you could put the minus. Yeah, this is what I was going to bring to you. If you want to do the opposite, flip the spread around, just put -1 at the start, and obviously that then is doing the opposite.
Yeah, that's actually, I'm going to say that's actually wrong. I don't know what that should. It should always start it out as buying the. Oh no, that was right. I'm right. I was thinking the other way around. Yeah. So if I do 1, here we go, 56. Oh no, so here the skew's the other way. That's what confused me. The skew's actually I want to do it. I want to sell it. So I want to buy the cheap one and sell the expensive one. Okay. So, but what I can do at this point is I could also add a D colon, and if I put a 0 in there, D is for delta, and again, that's going to show up over here, down below here in the samples. You should be able to see there's delta in here. Maybe delta's not in there, but you'll see it in this doc here. Okay, but if I say D0, it'll say go out there and hedge this on that day and make sure there's a 0 delta. So right now we have a delta. Well, we don't have the delta in this view here, but let's go and hit this. Okay, and here we see there was a 28 delta, so we hedged accordingly. Okay, and now we have we hedged it at 56.16, and here's where we are right now on this one. So you made some money because you were long futures on the initial trade, so you see a little bit of a premium increase over here, and here's where your futures are now. So you can go back and look at individual spreads. You can go back and look at spreads delta neutral, okay? And you can even go as far as saying, oh, I don't want to do it at I sold this call spread, but I actually did 56s. So you can do F56, okay? And if I do that, it will put in the 56 here for the future price. So lots of ways that you can really target what you want to do on a given day. Now it's different, right? It's going to go and price this. If I take this future off, okay, it's going to go and price this with the settlement future, as Hugh mentioned, all the time. But you know, you can target that future price yourself if you happen to, you know, if you have something written down, or you want to see how much a change in that future would have affected your price, that type of thing. And the other thing you can do too is you can actually put the delta in here. So if I do 0.25, it's going to give me a 25 delta only. So 0 is our shortcut to say make it delta neutral, okay? And that's sort of the point behind this one. So this is the real, and you see this is still, because this thing's still around, it's not treating this like a true back test. But if I go here and say 30, okay, now you're going to see it should treat. Am I still? Oh, I still got F. So let me go back even further. Let me go to 10. Okay, now it treats it like a back test, and here it is, and I can add this to my back test tab. Okay, so that is I think really the easiest way to go back in time and see what something has done. Now, what we've done to this point is we've only showed you what's going on in this tab, but as part of this back test, right? This thing is expired. It was a no contract on this day and time in the past, but you'll notice there's a current tab. So I can click on this current tab, and what this does is going to say, it shows me what's the closest thing that exists right now to this back test. So we're looking for something that's closest to the 30-day that exists right now. So if you want to do the same trade now, this is what you would do. 58.5, 62 call spread. That's your current one. And then, so you'll notice, right, we had about, see, here's the 16 DTE. There's really nothing closer. Here's our current spread that's closest to this, and we're going to get to the 40 DTE, okay? And you also have charts tab. And this shows you what this trade did from inception until it expired, okay? And there's more charts over here. There's the P&L, there's the actual data, okay? So it's a table of data. There is just the option values, okay? So you can see what the TVs on that were. You can see what the future did, and you can also see what the vol did. You'll notice that you're probably thinking, why don't you just do more charts on each individual chart? We're gonna start to consolidate some charts as well. So you'll see futures prices on here, as well as we only can do 2 axes, so we probably see vol and future or vol and price or whatever. So we'll work towards making those all be part of the same chart.
Or maybe like a multi-pane chart, something like that. But the problem is sometimes I don't really like the multi-pane charts, because you lose the granularity in the chart itself. So I don't even mind having 4 different charts, because it gives you some, you can really see what actually went on there, rather than because I do find with some of the charts, when you stack things like 3 or 4 things above each other, you do lose out on that anyway. But
right,
maybe that's just me.
Some lost fidelity on the actual values of the chart series.
Yeah, because you're just crushing the y-axis, and then that's, so you have to just fit more into a smaller space.
Right. So finally, then one other. Let's see, we have some chat. Put somebody chat.
Yeah, we got a question.
Go ahead. Let's have some.
All right. So do you want to do the seasonal and the DTE tab first, and then?
I'll take a question, and then we'll jump.
All right, go on then. Right. Okay. So this one. Do you think we could do an example of what most retail traders do? Sell iron condors and see how it could go wrong. Iron condors aren't actually a trade I regularly do, to be honest. At all. Either way, I don't buy them, sell them. I've not really got a huge interest in them. But that's because there are a lot of option strategies, and a lot of the time I'm either mainly trying to do skew trades, or I'm trying to get a directional trade and then use skew to get as much bang for my buck as possible.
So, here's an example. Let's answer that question with the actual example. So you notice I forgot that I didn't have to do anything to. So here we have our iron condor here. All right, at the money +2. So I started at the money and I did a +2. So this is telling me what things are right now. So this is a 70 days to expiration. So let's go back to let's do a 60-day to expiration. Let's see what we get. I think we'll probably get the same contract here. And now let's go back to a point where we know that this thing expired. So let's go back to DT, and we can go to let's go to 10/1/19. Okay, let's go find the 60-day iron condor on this day, and let's see if it made any money. Okay, so to the question out there, let's do this. And now we're going to see this is going to be a back test. Okay, and here it is. It was 53, 4, 5.5, and 6. And you'll notice when we landed on the chart there, here was our P&L for this. So this really did nothing, right? And part of that has to do with the fact, in all likelihood, that if we look at the future during that period of time, it didn't have much going on. So we didn't really get outside of anything there. So based on what we paid versus where the thing ended up, not much.
Is that a short iron condor though? That's a long condor, right?
Oh, did he want to do short? I'm sorry. Short
he said, most retailers sell iron condors and see how it could go wrong. Well, the other part is, if you go back and look, you can use this to go and see how it went wrong. Right,
exactly. So your P&L is going to be,
kind of the opposite. Yeah.
it's not, it's just on the other side, but there's really not much going on there. So yeah, you can, I mean, that's a great example of looking at something that you heard works or something that you like to do, and just go back to any period of time and, you know, and decide whether it works based on what the P&L is, you know. So so yeah, I think you have at it and see what happens. So with that said, I'll jump over to this until we get on any other questions. So on these, on all of these spreads, so let's go to a spread that exists right now. So let's go to this March one. You're going to see that we have seasonal and a DTE tab. So seasonal, when I click, it's going to take a minute to load because it's doing a lot of work behind the scenes. This is going to load up all of, so we did the March contract. So this is going to load up all of the March contracts over the last 10 or 12 years, however, whatever, depending on what product you're in, and show you what those particular, what this at the money +2 condor was in each case. Here, you're going to see here, it's titling it up with what it is currently, but as you go from year to year, you're going to see this was the 52.5 to 56.5 in March 19. It was different in March 18. You know, here's what it was in March 17. I mean, it's pretty interesting, I guess, is that you're not seeing much variation here year over year in terms of where we are from a price standpoint, at least at that point in time, meaning with this many days to expiration. All right, and the other nice thing that you have going on here is that if you click on the symbol, you can bring up the information, the historical information for this individual spread. So you can see what the P&L looks like from a chart. You can look at the data, etc., and the option, future, and the vol as well. So that's the seasonal. That means it's going to stick with that particular contract. So you do June, it's going to show June. You do March, it's going to show March. When you look at the DTE tab, what this is going to do is it's going to go back in the database and say, okay, right now we have like 70+ days to expiration. Go back, start now, and go back and find me all the contracts, regardless of what season it is, and give me all the 70-day contracts. So you see here, this is showing you when the March was 70 days, when the Feb was 70 days, when the Jan was 70 days, when the Dece was 70 days. So it's just going to go step back serially as opposed to seasonally. Okay. So I guess maybe that might even be a better word, is serially, seasonal serial, something like that. That might be misleading. Okay. So that's what these two are. And then finally, I'm just going to show you this since this popped up, and you'll have a better idea of what's going on here. The summary tab is just going to take whatever you have over in the active tab on this side, and it's going to show you just all the pricing for what's over here. So in the recent, it's showing me what I have listed. In my spread, it's going to show you what I have saved. Okay. And the more there are, the longer it'll take to calc because it is doing some work. Same thing, generics, etc. It won't show. Here's only the generic, and the generics will be there. But I particularly like this for the generics. So you can set up all of the stuff that you like to see, and it'll pop it right in here. And what I notice now looking at this, what's missing here? What's missing is what I'd like to see here. Oh, on the hover, I can see what my actual strikes are. So that's good. I don't know if I'd rather see it. I wonder if I'd rather see it as the actual strikes or as the generic. So in any case, you can hover over it and see exactly what it is. Okay, so that is sort of the quick and dirty backtest tutorial. Like I said, there's lots of cool stuff that you can do. Let's do a couple other examples. So because these guys talk about it quite a bit. H0 25DRR, right? So you can go right away and see the 25 delta risk reversal. You can go in there and, you know, delta neutral this, right? So lots and lots of things you can do. You know, you see all the charts like we mentioned. This is what your P&L looks like. This is your P&L chart, or your expected return chart. You have your history for this thing, so you can see how this thing has fared over time. You have your seasonal DT, and again, your summary. So are there any other questions here before I turn it over to Hugh and Adam to kind of roughly finish up?
I haven't really seen any questions.
Let me see if I can ask some leading questions for people based on some of the samples out here. So there are some future things coming in here, but they're a bit away, so I'm not even going to talk to those. But let's talk about some of the other. Let's just do some of the other.
Oh, one thing I noticed. Sorry, before I forget. When you want to select, say, LO, then a number and then exclamation mark, is there? Like, I was trying to do 6 before, but that was rejecting.
Let's see. Should work. It should go all the way to. It should go up to 9. I think it should go all the way to 9.
Maybe it works for this. Maybe I was doing a future that didn't have 6 active. The euro has 6 active fronts, I think.
Yeah. So it should go. It should. I think it's even taken up to. It's just basically all this is doing is going through our list and finding it. 10 found a weekly.
Yeah, Crude's gonna have way more, isn't it?
Yeah.
Yeah.
So that's there. So, but some other interesting things that you can do here. So you saw that I had, you saw that I did the ATM +2, right? +1, +3. That's just going to step through. So if I do, I can do call spread here, and it's going to do a 2-strike step there. Okay. But what you can also do is I can also put this multiplication sign there, or asterisk, however you want to think of it. If I do that, what that's going to do is it's going to go 2 strikes around the at the money. So it's going to find the at the money, and it's going to go 2 to the left and 2 to the right. So now I can do a call spread that bounds at the money. But I particularly like this for something like this. I can do a risk reversal around the at the money, so I can get 2 strikes to the left and 2 strikes to the right for a risk reversal. And so I find that to be real interesting. And I also I like it for this too. So I can do 2 strikes around strangle. Okay. And then again, you can do the same thing here. You can do 4. Right? So it's a quick way to really see what's going on without having to know exactly what strikes you're working toward, because Hugh, Adam, and I, we have conversations in Delta all the time. So you start out in Delta, you get your sort of initial strikes, and then from there you can make adjustments on those initial strikes after you find the stuff that's the closest, because sometimes you'll get something that's 24, something that's 26. It might pick the 24, depending on how far out you're going, that type of thing. But you have a lot of, you get yourself started here, and then you can play around from here, and make adjustments once you here. So if I had this spread, right? So now I have the spread, I can put it in here, and you can just come in here and change it to 62. And now there you go. And one other thing I want to point out too is everything shows up with a link underneath it. Anything that's active, you can click on this. Did I get blocked? I did get blocked. There's a new browser somebody told me to try, Brave, and it's pretty quick.
Is it built on Chromium as well?
I don't know. I don't know if it's like Yandex or not, but it's pretty quick. Did this window pop up? Can you see the extra window? Yeah.
No.
Okay. Anyway, it will open up in Spread Builder, so you can play around with it and do what you need to do there. So again, keep in mind the samples. That SQS is part of QuikScript is part of SQS. Then you have the QuickDNA, which you've seen multiple times from.
Yeah, I mean, I've used QuickDNA on, and now it's actually been released. I'll probably use it on the, I'll use it in this format instead of just showing screenshots of it. So you just wanted to get it finalized, right? So
yeah, this tool I think is going to help your trading, because a couple things are going to be, I tried to put out a tweet today that only saw eyes once the Macrohedged guys actually tweeted it out. But this is not only a tool for the extremes when you see dots way out here on the left or the right, expensive or cheap, but it's also when you start to see things get compressed over here. There's activity. I mean, there's availability of trade when not much is going on, right? As well as when there's some craziness happening. So,
and it depends what sort of trader you're doing, what sort of things you like doing. I mean, yeah, because you've got to tweak what statistics you want shown there as well, right? and then what products. There's probably, for some people, there's probably no need to go through all of the products. Well, we've got a question here. Someone got the wrong a space. They didn't have a space before the caret. Okay. And then it said, can you export the DTE series to Excel? I'm going to assume that's in QuikStrike. And then obviously, like maybe that one.
This one. Well, we don't have a specific
export button.
But if you do this,
that'll get you there.
It'll get you there.
Yeah. I know that on charts, if you the data tab on the charts, that has or it did. You could probably do the same thing there.
You can cut and paste, but that's something I'll take note of, that it's a possibility that we can get an export functionality there as well. But yeah, that's a good thought.
All right. Okay. So another one. How do we determine if an option is cheap or expensive, since it's hard to measure? And that brings us into QuickDNA. Right. So we've gone through loads and loads of things here. Right. So we created. So I don't know. There's not really enough time for this. But you can look at the skews. Like skew, put skews like Nick's in there, or you can look at cross delta skews. So you could say, okay, what is and look on the YouTube market stand up today, being the 5th of December. I went over and showed you how I was comparing the euro vol, so looking at the money vol versus say 10 deltas on the call side, and showing how they are extremely rich at the moment. And rich, I mean, how do you determine rich or cheap? Well, that's kind of, whether you Z-score it or over, say, I don't know, 1 year look back, 2 year look back. There's pros and cons of Z-scores over depending on the look back window, right? I mean, when you start saying, oh, well, and the problem, there are other problems with it, bits and pieces, or maybe you apply, say, a standard deviation band with a rolling average, very similar to a Z-score anyway. But yeah, this is essentially here displaying Z-scores, QuickDNA. So you kind of have to decide what you want to do before you're determining. There's not like something you can say, this is rich, sell it every time. This is cheap, buy it every time. Because different products have different things. Like, so I'll get onto that.
And I would say too, something may not be rich or cheap in and of itself, but it may be rich or cheap in comparison to another part of the vol curve within that month itself. So here we have a 30 delta, 10 delta vol spread. So you can start to see whether things are, in here, this starts to look like it's kind of cheap, this 2 year delta put skew on the 30-day. That means it's probably pretty close to being on top of each other. So so sometimes you can do spreads when two areas, we'll call them strikes, even though they're deltas, when two strikes start to get valued rich or cheap in relation to each other. So it's not necessarily just outrights, but it could be, relationship of the individual vol curve to itself, right? So that's really how a lot of trades that these guys are doing. They're doing stuff relative to that vol curve. So it's not rich or cheap.
So go back to say, like, there was the trade when we were doing, so don't think like, so certain commodities and certain things, they will get rich and they will get richer, or they will get cheap and cheaper. Like, so nat gas, say certain times a year, the wings are gonna get richer, right? They just are, and they will trend, and obviously they will then have higher, that spread between the two will blow out way more often. But then, something else that's unlikely going to have the seasonality and the reason why it's blowing out behind it, then you're likely to fade it. But I have been over a lot of this other stuff. So measuring historical vol versus implied vol, not the best way to go to determine if an option is cheap or expensive. No, I think personally, I think it's a terrible idea. in the same reason, because you're measuring an implied, something that the market is implying versus whatever your look back average is. So whatever something was in the past, the past data is you're assuming that past data is predictive. The easiest example is take the sell-off last year in the S&P, right? What happened in the sell-off in the S&P? Implied vol spiked, right? And then after a while, the historical vol spiked, right? Now, when we start climbing again, the implied vol's getting crushed, right? Now, the historical vol is saying the implied vol should be higher. Why? It doesn't make any sense. It's that, but because it was higher in the past. So that it's a, if you had a 200-day look back, does that, is it rich or cheap again? It doesn't make any sense. And you're looking at something based on an average, and I don't think averages are a good way of measuring things, because they give you no idea of the distribution. So I think, and I also do cover it in the course. I do talk about this. It's a common metric used by someone else. And what about doing implied volatility analysis, so like comparative IV analysis? Well, yeah, but I'd have to normalize them. I wouldn't compare SPY IV to QQQ IV on just the numbers. You'd have to normalize them somehow, and maybe convert them into a Z-score them. Then, see, this is why QuickDNA is great, because it's normalizing everything across the, you're not actually comparing raw numbers, you're normalizing it into a Z-score. So then you can say, well, this is rich or cheap. But then it does have the issue that obviously it has a look back window. So then it has a 1 year or a 2 back look back window. There's pros and cons of everything. There's no perfect solution to it all. And if there was, the markets wouldn't exist. So, I mean, I think a 1 and 2 year look back window is probably sufficient for most of what we would be doing. I'm not sure whether, if you want to chime in there, Nick, at all. Or...
No, I agree. I mean, especially for if you're, I mean, the 5 year window is pretty, that's going to give you an idea of maybe, some events that took place that were really out of whack, right? So, we're even looking at potentially doing a sliding period. So we have 1, we have 2, but we're even looking at saying, well, go look over this period of time. So you'll be able to go from like June to June or something like that. So 1 and 2 tends to be okay. I think you want the longer dated history, so you can sort of get an idea of where the potential opportunities are from the extreme ranges standpoint. That's why people look at the historical data over a longer period of time, so you can see where the potential opportunity is. So if something seems out of whack over 2 years, and then you look at a longer dated one and you see that it's really not that out of whack when you're looking at it from a longer period of time, that might just be that we've had a quiet 2 years. But generally speaking, you're going to have cycles within that period, those periods of time, like you were saying, and you're gonna have plenty of information to make a trade from there. So
maybe the time I would go back is we are in what you could say is a new normal at the moment. So I would want maybe looking at something, if there was something that had fundamentally changed, as in like interest rates are very low. So maybe, obviously we've been this way for a long time now, but say you wanted to see what it was like before the Fed started hiking or something like that, maybe you would, maybe we'd look at it like that. That would then cause you to go back further. But I think the 1-2 year window is okay. A 2 year look back, I think, for a lot of this stuff is good enough. Especially when you're just looking at QuickDNA, when you're just getting an idea of where there might be a potential trade. You're not just basing a trade off of this, although there are, a few things, and I've looked at this and I thought, wow, okay, there's a great trade there. And you could probably build a trade in your mind quite quickly, or based off of the stats you can create on here. obviously I'm not just doing that, right? I'm going to then go and do a little bit more research. But I think we're nearly at the hour mark. So I had a couple of things I was going to talk about, but I might just bring them up on the YouTube tomorrow on the stream, because it's 9 o'clock here. I've still got other things I need to do for the day's up.
I'll mention one other thing too, and then sorry to.
Oh no, that's fine. It's just I don't want to start going on to another separate topic.
But just to give you an idea of what's going to be available here, even. So let's quickly do something, if people don't mind, just taking a look here for a second. Still have participants here. So I'm going to build a spread really quickly so you can see what's going on. Let's do the March. Oh, I can hear. You'll notice that I can use the SQS nomenclature here as well, and it'll build my straddle for me. All right, so now I'm just doing this so I'm going to lock this, and I'm going to save it. Go back to SQS. So what you can do with this new alert section that we're releasing, or that's released, you can now add triggers. So you can add futures price triggers, options triggers for a particular price you're looking for, historical volatility triggers, historical volume and open interest triggers, and you can also do spread triggers. So what price, let me go back. I didn't even look and see what price that was. What was the March at the money straddle? Okay. What do we got? 5.93. Okay, so now if I go to alerts over here, I can add a trigger, and I could say I want an out of range trigger, and I'm going to pick my March straddle, and I'm going to say when I'm above 60 or below 57, okay, I want to set an intraday and an end of day alert, and I can say finish. And now you can set up so you'll get an email when the straddle goes below 57 or above 60. So it's a way for you to kind of, if you like something or you think you like something, or you guys talk about a spread in the stand-up, now you can go in there and build that spread and say, let me know when the theoretical value for QuikStrike puts that in a particular price range. So these are going to be these will be fun as well. So anyway,
yeah, that really changes a lot of things. That you can keep an eye on a lot more spreads, a lot easier, because otherwise sometimes it is hard to keep track, even if you're just building them and your front end where you're executing them. It's easy to, if you're analyzing them in QuikStrike, it's better just to keep them in there and then get the email alerts. I don't even think most platforms email. I don't think TT or CTS, you can set up email alerts for stuff, even if you did have the spread built in there. So this works well.
Yeah. Anyway, yeah, you guys, thanks for listening. If you got any questions, just shoot me a note, support@quickstrike.net, or chat us up in the
everyone's on Twitter. So and obviously you signed in here, so you know where we are. This will be posted to YouTube anyway, so you'll be able to rewatch it. And yeah, thanks for coming along. Cheers. Thanks, Nick.
All right, guys, take it easy.